Everybody, good morning. It's Friday, July 19th. This is Rick Mount, part of the Mike Hardy and Rick Mount team of Fairway Independent Mortgage. Wanted to bring you this week's quick market update. A lot of optimism out there going on, and the economic data that's being reported is suggesting the economy is continuing to improve, and people are continuing to look for positive news. So as long as the leading indicators and data being reported confirm the optimism, then according to Federal Chief Ben Bernanke, the federal government is going to begin to reduce or taper their efforts to continue to keep rates low. He spoke on July 5th, and it spooked the markets because he suggested this tapering could happen sooner than later. We all know that it's inevitable, but the timing of it could spook the market. Since then, we've seen the rates sort of stabilize and recoup some of those losses as he's made a campaign of coming out saying, hey, well, we're going to reduce based on the economic indicators. So it's going to be a little bit of a bumpy ride. It's going to be a little bit volatile, but recently we have found some support. So we think we're stable until the next unemployment report comes out, and that might be a market mover one way or the other. So with that being said, where are we? Well, rates have trended up almost a full percentage point in the last month or so. We're now sitting in the mid to high 4% range for a traditional 30-year fixed rate mortgage. But I know that sounds high, and we've moved up a little bit, but wanted to go back and look at a little bit of a historical perspective as it relates to interest rates and affordability. So looking at the average 30-year mortgage rate over the last 30 years, the average is 7.91% per Freddie Mac's historical rate averages. Also, looking at the 2002 to 2007 era, in which we saw the single biggest increase of housing appreciation during that era, the average 30-year fixed rate average rate of 6.1%. So still a full 1.5% above where we're currently trending. So rates still in the mid 4%, home prices still well below their highs, housing affordability still remains at or near all-time favorable levels. Yes, the market's evolving, but the recent housing increases, many people were previously underwater, now have equity in their homes. This is allowing them to consider selling their house through a standard transaction and taking advantage of the still historically low rates, still well below the highs of housing markets. This is adding a lot of much needed inventory to the marketplace, and we're starting to see the recent rampant appreciation come under control, and we're starting to see a healthy level, more sustainable level of housing appreciation, both adding inventory to help some of the first-time buyers out there and the many people that are looking up for move-up. So with rates still historically low, housing affordability still very high, and housing prices still well below the lows, many people are considering if they're in their forever home. It's a great time to consider whether to sell and move up, to sell and downsize, to sell and relocate. So we're seeing a lot of activity out there, still a very healthy time. So if we can help you make a healthy decision, we're here to help. We look forward to working with you. So have a great, safe, happy weekend, and we'll see you the next week.